Well, you haven't heard this voice in a while, I'm sure. This is Kai Whitney, Redbridge Capital. I just wanted to kind of reach out to you a little bit. I'm getting lots of interest because of this crude oil move here in the Saudi attack. But I just wanted to preface this by saying this is not something that I anticipated happening. It was just the probabilities of a bull market in energy were setting up. And the key now is not to chase oil at these levels at $60 as it's gapped up, 10-20% overnight. And this is Sunday night trading, by the way. So there's very little liquidity. You really want to let this market trade through and show itself through its liquidity in size. But if you were to look at this as a lesson to learn going forward, because this will happen time and time again, over and over the very same way. If you set yourself up into higher probability trades where risk is mitigated, you can take advantage of it in many different ways, whether it's through futures trading, options, ETFs, positioning yourself in your 401k, you name it. But the key is being able to see where the institutions are putting their money to work. And what they do is they're not looking at earnings per share anymore. They're not looking at price to sales, and stock buybacks aren't making a difference anymore because it's all cheap money anyway. They're just looking at valuations, and it's valuations relative to the market that it's trading. And you have to take that over time. So when I posted this here, we're setting up for a big energy bull market soon on August 28th, 2019. Right now we're September 15th, 2019, and that's I guess it happened overnight where there was attacks on the Saudi establishment, and it's going to react. Crude oil is going to react to that, and obviously the world is going to start releasing oil and try to calm the markets down. But the key is that if you're not positioned for that to happen, there's no reason to chase it. Okay. So anyway, this is what I want to show that I teach. What I'm showing is money flow. And we're looking at institutional money flow. Now, there's a number of ways we're going to watch this, okay? So first, I'm going to look for something that's been around since the Dow, over 100 years. And it's just basically taking a look at each sector and each market. And we're taking a look at the difference between the buys and the sales, and we're basically measuring where money is coming out of the market or out of that sector or into that sector. Now here's it's called the bullish percent energy sector. Okay. Now obviously the best opportunities to buy are when everything is negative. There's not a single analyst estimate that's positive. Downgrades are happening. Everyone's talking short. CNBC is looking for you're just looking for everything to go out of business. And that last happened in December of 2018. And the bottom of 2018, leading into January 4th, there was private equity stepping in and buying up shares on the cheap based on valuations. We can see that this here opportunity was the best buy opportunity. You can look from my Twitter stream to see how I posted information about what to buy, when to buy, why to buy. Okay, and again, it all comes down to probability and valuations, because we're all using leverage and risk analysis to make our decisions. Everything else that happens afterwards is up to the market, but the probability of being on the right side of that trade is greater if you're trading along the same matrix as the institutions who control the market. So what we're looking at here is the absolute lows for energy. Then we see the retracement to come up to where 90%, well, not 90%, 75% of all the energy related stocks were bullish. And that was in the peak of May. Sell in May, come in. Then we have a bottom in August, and then we have a lower high in August. And then this is where I posted that tweet there, August 28th. We're setting up for a big market. I also mentioned on the September 9th, back up the truck in everything energy and oil related, whether it's crude, ETFs, energy ETF, you name it, just buy it. So we are now the 15th, days later. Now we're seeing some results of being prepared. And I'm going to show you here. The liquidity is just not here yet. This has refreshed, but liquidity is not here, so you can't make a trading decision yet. But we closed on Friday 54, 52. We're trading right now 60.17. We are at the top here of value, right? When you want to be interested in buying this stock or buying that commodity or buying whatever you're going to buy is when opportunity is tested lower and rejected. So the market is auctioning lower to find the buyers. Found buyers here in August 7th was the first opportunity. That's when you first start looking for opportunities. You start looking for dividend payers, good companies, diversifying through ETFs, and you start looking for block trades to come in on the long side through crude. And that's how you're trading. Then you're going to get reactions and more tests. Here's another test here on August 23rd. And what was that? August 28th. I said back up the truck. We came in on the 3rd, another opportunity to back up the truck. Then we're here on another test at 54.23, and we gap higher at 60. Now, I'm not saying I predicted, obviously, a 10-20% gap up for some drone strikes. But I'm just telling you that the probability of buying and selling when you are using an auctioning market and you're trading along the ways of what the institutions do, you're gonna fare better than just trading long crude at 60 now when there is no liquidity. Who knows what's going to happen? Who knows if the Fed's going to step in, reduce rates, oil supplies, oil reserves across the world going to flood the market. This could come straight back down to where it's basically its median, its mean, its average, where it logically wants to be is at 56. Doesn't want to be up at here at 60, wants to be at 56. So anything beneath 56 is a discount to the mean, to the average. And that's when you want to start looking at where are the buys coming in, at what levels. Are the sales coming in and then price rejecting that sale? That's the importance of looking at the markets. I'll go to this last chart here, crude WTI. And this is from 2017, 2018, 2019. This is looking at the Commercial Traders Report. You can get that through going to the CFTC.gov. Then you go to Market Analysis, Commitment of Traders. You can learn about Commitment of Traders. These are going to be the largest reportable document. These are going to be the largest reportable trades held by the largest traders in that in that security. Whether it's financials, metals, electricity, nat gas, petroleum, you name it. You're going to look through that, and if you want to track it, you're going to want to look for divergences in price relative to large speculators, what the large speculators are doing, and what the managed money is doing. You don't want to worry about swaps, you don't want to worry about producers, and you don't want to worry about commercials. Small speculators are going to be more hedge fund type. Large speculators are going to be institutions and insurance companies, managed money. It's going to be more mutual funds and things of that nature. But you want to look for price extremes and then upticks in if you pull one of these up, you're going to see open interest. And you want to look at open interest relative to the price. So in other words, if price is trading higher, you want to see open interest gaining as well. If price is trading lower, you want to see open interest falling. And that will give you the clear direction of reportable positions. This may be a lot, but I just wanted to throw this out just because now is not the time to be trading crude. You want to let this settle. You want to let this trade rotate. If it's going to trade higher than 60, you want to see this rotate around between 58 and 60, the high end here. Then, let me get this out of the way. Then you're going to want to see it trade back to where it was last rejected by the sellers. So where were the sellers in the market prior to this up move? And that area is back up at 61 back in July. And then here in May. So May and July were the sellers. So as we tag into the 61 and maybe even higher, we're going to start looking for larger block trades than this. And we're going to want to see a negative price reaction. But you don't want to just throw on a trade just because it gapped higher. You have no idea what can happen. This is a news-driven event, and all that's going to happen is the market makers need to keep a market stable, and they're going to need to find bids. They're going to need to and pair them with sellers and cross those trades and match those trades. Large companies, Chevron, Exxon, are all going to have to hedge. So you have no idea what to do at this point. So in other words, if you weren't long, as we were, getting into the market of crude markets, anything crude related, remember, backing up the truck in anything crude related, where was that? Back up the truck in anything crude related. If you weren't doing that before this happened, it's not time to do it now. Don't chase. I've already got a lot of pings, a lot of texts, what do we do about this? And the answer to me is, if you're not long, you don't do anything. And if you are long, what you're doing is you're waiting for this market to find liquidity first. Then, if it starts to trade higher and we start to see more sellers come in and price start to fall, then you want to peel out of some of those long positions. And then you want to wait and see how it negotiates that median fair price at 56. So anything other than that, just sit back and enjoy the trade. Enjoy the fruits of your, either whether it was luck, or that comes from hard labor or understanding the market, or just learn for the next time. Don't chase this time, you'll just lose. That's my message. I hope it helps. I'm just going to post this. Whether you hate it or not, God bless you.